We are now going to lay out a very simple, very basic portfolio for retirement. While we're saying it's basic and simple, it also has a lot of strengths. You could make a much worse portfolio, and in some cases, it may be doubtful how much better you can improve on this portfolio. To do that, we're going to look at an article that appeared in NPR. You see the link listed here. It's also in the description of this YouTube video. This article gives the investment strategies of three investment individuals, and one of those is from John Bogle or Jack Bogle, and he is of Vanguard fame. He started Vanguard, and he is the individual that made low-cost index investment a thing. Here is John Bogle's advice. Buy a stock index fund and own your age in bonds. Pretty simple. That is it. And he would say when you're making those investments in those stock funds and those bond funds, invest in mutual funds that have low cost, that are indexed, so you're not trying to beat the market, and that also leads to low cost because you have less management of those, and you're getting wide diversification. Jack Bogle or John Bogle did not believe that most investment advisors can beat the market, so rather than try and beat the market, follow the market and keep the costs low. Here is several examples, and again, this come from the article. You have the stock index funds he would use and the U.S. Treasury bond funds that he would use. I would note those stock index funds, Fidelity Spartan 500 Index, Vanguard, his company, Total Stock Market Index Fund, and Schwab. They're all index funds, and as you can see over the right, they have very low expense ratios. Treasury bonds, he would suggest, again, an indexed approach, very low cost, or try and keep those expense ratios down. And he again gives one of his and one of Fidelity's index funds. Almost all investment companies, Fidelity, etc., Schwab, have index funds in which they try and keep the cost low. So even though Bogle started the innovation, it's now spread through the industry. Again, Bogle's approach, he believes that cost is everything. Keep those costs low, and you will have more in the fund at the end, or more in your retirement fund at the end. In other words, he does not believe that you can increase the annual fee on the fund, get more management, and that management get a higher return that offset the additional cost of the fund. Again, another big thing about Bogle's approach is diversification. Stocks versus bonds, he wants you to own more bonds as you age. And here's the fundamental trade-off. Bonds, typically, you think of bonds having lower returns than stocks, but also much less risk. So the idea would then be you put more of your assets into a bond fund as you age. You're getting closer to retirement, and as you get closer to retirement, you already have hopefully a large amount of investment, and so protecting that becomes more important. You don't want to have that 40, 50, 60% drop impact your whole investment when you're getting closer to retirement. Again, here's what he would say. Age 25 to 35, you would be putting 30% in the bond fund and the rest in the stock index fund. And then 55 to 60, you would have 40% into your stock index fund and 60% into your treasury bond. So you're shifting over time, making it less risky. He would also say consider Social Security. So Social Security is a retirement that you could have coming to you. It's supposedly safe. So as you're building into the fact that you have this retirement from Social Security, that might lead you to making more investments in stock in the remainder of the portfolio. So here is Bogle's recommendation, and we'll use this as a starting point. Gives you a feel for where you should be. Stock index fund, Again, he would stay stock index one. 1 minus your age is your portfolio weight. If you are 25, you would be putting 75% of your funds in a stock index fund. If you are 25, that would mean the rest of it would be going to intermediate or short-term treasury fund. So that is the simple and basic bond fund that you can put together for retirement.